審議上述條例草案嘅委員會主席梁繼昌議員就委員會嘅報告向本會發言。梁繼昌議員。
Acting President, in my capacity as Chairman of the Bills Committee on Inland Revenue Amendment Bill 2014, I now address the Council on the work of the Bills Committee. The Inland Revenue Amendment Bill 2014 seeks to amend the Inland Revenue Ordinance to give effect to the proposals concerning tax concessions in the 2014-2015 budget. These proposals include increasing the dependent parent and grandparent allowances, as well as the additional dependent parent and grandparent allowances from $38,000 to $40,000 for each eligible parent or grandparents aged 60 or above, and from $19,000 to $20,000 for each eligible parent or grandparent aged between 55 and 59. Next, raising the deduction ceiling for elderly residential care expenses under salaries tax and tax under personal assessment from $76,000 to $80,000 for each eligible parent or grandparent. And finally, reducing salaries tax, tax under personal assessment, and profits tax for the year of assessment 2013 to 2014 by 75%, subject to a ceiling of $10,000 per case. Acting President, the Bills Committee has held one meeting with the administration to scrutinize the bill and has invited the public and the district councils to provide views in writing, but has not received any submission. The Bills Committee supports the bill. During the deliberations, the Bills Committee has examined the rationales for the tax concession proposals and their financial implications. The Bills Committee notes that the proposed increases in allowances and deduction ceiling aimed at alleviating taxpayers' burden in maintaining dependent parents and grandparents, whereas the proposed one-off reduction of salaries tax, tax under personal assessment, and profits tax for the year of assessment 2013 to 2014 is one of the counter-cyclical one-off relief measures in the 2014-15 budget. According to the administration, about 550,000 taxpayers will benefit from the proposed increases in allowances and deduction ceiling. And the revenue foregone is estimated to be about $300 million a year. As for the proposed one-off tax reduction, about 1.74 million taxpayers and 126,000 tax-paying companies will benefit, and the revenue foregone is about $10.2 billion. The Bills Committee notes that a married couple who receives employment income may elect to be jointly assessed if the election can reduce their overall tax liability. At the request of the Bills Committee, the administration has provided information on overseas jurisdictions in respect of their adoption of joint assessment arrangements for taxpayers. The administration has also provided statistics on the election of joint assessment under salaries tax and on the election of personal assessment in the past 3 years. Section 3 of the proposed Schedule 31 to the Inland Revenue Ordinance, under Clause 7 of the bill, also seeks to provide an additional ground for taxpayers to apply for holding over payment of provisional salaries tax in the year of assessment 2014-15 if the taxpayer is entitled to a deduction for elderly residential care expenses that is likely to exceed $76,000 in that year of assessment. In examining this provision, I have suggested to the administration that instead of enacting similar transitional provisions each time adjustments are made to the deduction items. The administration should consider introducing a standing provision in the ordinance to include entitlement to deductions exceeding a certain amount as a ground for application for holding over payment of provisional salaries tax. And the administration, I noted, agrees to give consideration to this suggestion. The Bills Committee has not proposed committee stage amendments to the bill and supports the resumption of the second reading debate on the bill. Mr. Acting President, I have a few personal suggestions and observations on our internal revenue system. Of course, some of these observations have been briefly mentioned in the above report. I will, though, cover those items in more detail below. During the deliberation of the Bills Committee stage, I have also inquired the administration whether a two-tier profits tax rate is possible. That is, a standard profits tax rate of 16.5% for the general corporations and a reduced rate, say, for example, a 10% profits tax rate for the SMEs. Well, how to define the SMEs properly will be based on turnover or chargeable profits of the SME concerned. Unfortunately and regrettably, the administration has replied that since profits tax is the biggest source of government revenue, such suggestions would require careful examination. Now, taking regard into such factors as the fairness principle, the financial implication to the government, and the susceptibility of such a two-tier profits tax system, thus calling for anti-avoidance provisions which would inevitably complicate the existing simple tax regime, the administration is quite unwilling to take into consideration the suggestion. The administration has also pointed out that in recent years, only around 90,000 of the some 900,000 registered corporations have to pay profits tax based on their assessable profits, indicating that Hong Kong's tax base is already narrow. With due respect, I do think that the revenue foregone by adopting a two-tier profits tax system is marginal, because by so doing, Mr. Acting President, you will also attract new business and enterprises to set up new businesses in Hong Kong. And if such revenue foregone is so marginal, then the argument that the profits tax is a major source for Hong Kong revenue should not stand. And in fact, by adopting a two-tier profits tax rate, Mr. President, it shows to the business world at large that we are concerned with promoting the competitiveness of our business and the competitiveness of our tax system. And I do urge the government in the next budget to seriously consider my proposal. My next observation, Mr. President, is about the joint assessment under salaries tax system. Mr. President, as we note that a married couple who receives employment income is assessed normally under salaries tax as separate individuals. However, they may elect to be jointly assessed if the election can reduce their overall tax liability. For example, if the husband and or the wife of a married couple have income that is chargeable to profits tax and a property tax, the married couple may elect for also personal assessment to reduce their tax liability. But separate taxation for the couple is not applicable under personal assessment. During the scrutiny of the bill, Mr. President, I have asked for the information relating to a number of jurisdictions whereby the joint taxation system is in place. Indeed, out of the 20 very developed economies ranging from Australia to Italy to the United States, only about 7 jurisdictions do adopt a joint assessment system for husband and wife. Mr. President, the reason why I asked for whether a joint assessment system exists in some of these economies is not much because I want to reform our fiscal system. It is in fact that the principle of equality, equality of sexes, which is the rationale of my question. Although husband and wives do form a family unit, but I do think the fiscal matters for husbands and wives should be segregated and separated. Now, by adopting a joint assessment system, I would urge also the Commissioner and the Secretary concerned to examine whether this arrangement would have infringed the Family Status Discrimination Ordinance and the Sex Discrimination Ordinance. In fact, the reason why a number of jurisdictions have reformed the personal tax system from a household basis to an individual basis is also based on the equality of sex principle. On top of that, of course, that is the data privacy principle that need to be observed. And I would urge the Secretary, therefore, to examine whether our current system for assessment for salaries tax for couples really reflect the social value which our society currently adores. Mr. President, I would urge the parties and my colleagues across the spectrum to support this bill. Thank you, Mr. President.